Hello, it's West Pacific Market Analytics with the West Pacific Week. Hope you had a great week this week. I've got something a little different we're going to be doing. I put together a slide deck presentation on this idea that I think is very, very important called a debt collapse. And I wanted to go over some of these models with you and talk about this because there's something going on under the surface that has me very worried. And one model in particular, I think we were within maybe days to a week to a month at most to something major underlying the markets. And I think they're projecting something very, very ugly about to happen. A major bank collapsing, a derivatives blow up, something political, something warlike. Issues more with Israel and Iran, something around tariffs or trade. I don't really know. I only know what I see and what I understand in the data models. So let's not waste a lot of time on the intro. I want to get right into this deck presentation. I put this together, this slide deck, and I wanted to use it for the West Pacific Week video here on YouTube. Again, if you want to get a hold of me, membership to our member Discord site right there, destinytrading@gmail.com. We'll send you some info. We do a lot of work over there daily. We've been talking about a lot underlying this market. We've been talking about this move ongoing by backing crypto 1-to-1 to the US dollar or to treasury notes, which is kind of crazy because wasn't crypto always designed to be outside the system and stand alone? Sounds to me like they're trying to reel it in and control it. I really don't know what that's all about. All I know is that control the money, control everything. And they want to control crypto. There's no question about that. They don't want it to be independent. And maybe that was never the purpose in the beginning. But let's not get into that. That's a whole nother day for discussion. We'll see how crypto does this week on that news. That could be interesting. We'll take a look at that. Now let's get into it. Let me put out the disclaimer here really quickly. These charts and updates for educational entertainment purposes only. Always do your own research and always take risk at your own discord. So please read it. Hope you had a great week, as I said, and we will get right into it here. This is going to be interesting, so just kind of flow with me on this. So let's do that. Let's pop up this PDF display here. And let's go over this. Okay, here's my opening page, West Pacific Market Analytics, Growth and Clarity, Illuminating Future Trends. Now I want to talk to you a little bit about this idea right here, the game-changing think beyond the box idea. And are you prepared to see it, understand it, and model it? We do future predictive analytics. We get outside the box. We think outside the box, and we see outside of the box. We're outside of all shadows of doubt in gifted clarity. Clarity is the key. We must take out emotion, and we must take out opinion. Okay? That is just absolutely so key. So we've got to think beyond the box. We've got to get outside of the way we've always looked at things, the way we've always felt what markets must do, and we're entering a period of extreme change. And you know, luck is what happens when preparation meets opportunity. So we need to prepare for what is coming. So let's get into this. Here is this idea of a debt deflation. And I don't know if you heard of Mr. Fisher. He talked about deflation via Fisher's debt deflation model back in 1933. And he highlighted how deflation increases the risk burden of debt. And it's actually another form of wealth transfer. Now, isn't that interesting? This idea of wealth transfer, where you're transferring wealth from the debtors to the creditors, which reduced aggregate demand and deepened economic downturns. And in 1933, after the 1929 to 32 collapse, Fisher published his seminal work, Boom and Depressions, where he introduced the debt deflation theory to explain the Great Depression. And obviously what's interesting here the key takeaway is velocity of circulation, which is what we model. I've been talking about it all the time, this idea of velocity of circulation, the the directional circulation of the momentum, the Mach, the momentum of circulation, the V channel, the velocity, all of that. And the second takeaway is notice what we get both a fall in both commodity and stock prices. And the third takeaway from Fisher's report here is the speed of velocity. So like he says here, it starts out with mild gloom and shock to confidence, and then you get reduced velocity of circulation. Now this is everything that I've been doing as you've been following me. We model velocity circulation, so be paying attention to that ahead. And you can see as we further go down here, right? Reduction in velocity as we get further into it. And again here, more slowing in velocity, more liquidation, right? And it's interesting. Notice here, fall in security prices, fall in commodity prices, distressed selling, more gloom. It's not pretty. It's all about liquidation, 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 debt liquidation, more liquidation, more liquidation, more distressed selling, more liquidation, more pessimism, and what a key word, distrust. It's getting liquid in what is going to become an illiquid environment. So let's go back again to our Dow model here. Now what's really interesting that if you take this box right here, remember we had that low, I talked to you about that, we had that low in 1904, and then we had the second low in 1932. And that first signal out of the 1904 high was the high at the 1929 top. And the high, and that was one signal, and then the second signal that developed out of that 1904 high has just turned over here at 2025. So we had one signal topping in 1929 and the second signal topping in 2025. I think we've got depression 2. I think we've got a depth deflationary collapse incoming. Now think about this. If you took this box of what happened here, first of all, notice the size of the drop. If you took the size of this drop, high to low, 29 to 32, that would take the market below this low right here, below the low of 2009. And that equals a model I call M equals A. Well, I've often said, well, that is not possible. Is it? It forms a very nice looking, which I'm not going to get into in this report, but up here it forms a very nice looking megaphone pattern. And it just seems so hard to fathom that we could go below the 2009 low. And yet the size of the move from 29 to 32 would allow that to happen. It would actually be smaller than the size of the move back here. Now, I don't even want to go there yet, because to get high to low, that could take quite some time. That could take, obviously, it took 3 years back here, and it could potentially take 5 years here. But it's something to keep in the back of your mind, because it's so odd how we have this signal, 29 and 2025. So, okay, I mean, it's just something we need to think about. Now, I'm looking, it's all about deflation, right? So we need to be really looking more so at deflation than we need to be looking at inflation. And deflation really is all about the fire economy, which we talked about in a previous report. Now, notice in this deflation model here, we had this high here, right here in mid-2019. You notice that? And then it took 4 months. So you can see here out of that signal, then we had 1, 2, 3, 4 months, and then we had the 2020 correction. Well, look at, we had the signal here, and now we've had 1, 2, 3. We're in the 4th month right now, the same before we had this large correction. So does that say we need to carry out into the end of July, which gives us 2 more weeks? Or could we start down at any time? Well, we're in a window of risk here that is extreme. And I'm going to show you that as we go further into this report. So that's the first signal I'm seeing here. And here's a model of deflation. You notice here going back into 2019, 2020. Again, this is what we're modeling, Fisher's idea of the circulation of velocity. So we're looking at 2 forms of circulation of velocity. The first is when I show you this blue. This is velocity of liquidity. And that's exactly what Fisher talks about. So you can see when we're getting these rising domes, this is a rising dome of velocity, a rising dome of velocity, and a larger rising dome of velocity. So we've had three here. We had a smaller one here at the 2020 correction. We had a larger one here at the 2022 correction. And now we've got even a larger one, a larger liquidity dome at the top here forming, and it's been a long formation here in 2025, and I think it's topped out here, and I think it's getting ready to head lower, but we got to see that happen, okay? But we got to see that happen, and once it starts down, you can see we get this corrective move, and then it was able to still go up. There's other reasons why it was continuing able to rise, because that could have been based on the technical patterns, like that one we just looked at previously here, right back here, for instance, where we had to get this signal rolling over. You notice it's only rolled over here in 2025. So again, this is this idea of circulation of velocity. Now here's deflation. Look at this. So we can see here, we got a bear cross here. Here's our high and that corrective move out of February coming right down. But notice that the dome, or the directional of circulation dome here, so this is looking at a velocity in a different way. What we're using here is what I call the V channel, which is made up of this pink line, which is the momentum of circulation, which moves much more radically. You can see here, up, down, and then the bigger dome, or the directional of circulation. So one is kind of controlling the momentum, and the other is the directional of the velocity of the circulation of liquidity. And you can see it's down, the Mach is at its lowest point. So notice here off of the high, coming down, rallying up, coming down, rallying back up. Here's the break. Rallying back up to the dot curve and coming down now. So you can see this big topping process occurring here in the deflation model in 2025. And it's starting all to roll over now. And what's price doing up here? And I showed you that model where I thought we had a Swan pattern top. I think I talked to you about that, or I at least should. I talked to that with my members. And maybe we'll pop into that if we get a chance here when I get to the end of this presentation. Well, actually, while we're at it, let's pop over there. I would actually like to show you that because I think that's kind of interesting. So let's go here. Let's find that odd looking, and got it right here. Let's go into this model. There's that descriptive if you want to look at it. We got it right here on the page. Here it is, right here. So take a look at this. You can see right here, this is a big Swan formation. And notice how it's popped out above here. You notice throughout the history of this model, you can see the SPX was always trading very cleanly to the pattern. And now we've got this pop out here, right? And if you look, this here and this here, this is the left leg and this is the right leg of the Swan. And you notice how we have a lower low here. So you need a lower low in the second leg of the Swan. And then out of that low, we've now formed the neck. We're going to form a head. And then this could collapse. At least that's how a Swan goes. And we can see this collapse way below this 4,800 in a rapid move. So this is a Swan formation right here, coming out of the 4,100 low. I didn't see this sooner, and I should have, but we have a Swan top right here. This is harmonic pattern. So, I mean, I think that is just really interesting. Sorry about the beeping in the background. That's over on my Discord page. I left it running in the background. Now, let's talk about this idea, because what typically in a deflationary collapse leads it is real estate. And here we're looking at home construction, okay? So you notice home construction velocity is topping out here. So we're really, you notice the trend's already broken, right? But I think commercial real estate could play a bigger driver, because real estate, both CRE, commercial real estate, and housing are key drivers of the deflationary defaults. And I wrote this: commercial real estate, the bigger, faster trigger. 1.2 trillion of CRE loans mature between 24 and 27, and most originate at 3.4 to 4% coupons. Refinancing at 7 to 8% coupons against buildings worth 30 to 60% less. Now, I follow a CRE expert over on Twitter, and he says, you know, some of the better real estate, we can maybe look at 20% less. But there's some of the really distressed real estate in some of the more difficult cities that we are seeing this 30 to 60% less, and sometimes even greater. And these are huge markdowns just over the last couple of years on prices paid. And he's saying it's possible without massive equity injections, we're going to have a huge problem. And I don't think the Fed can do that right here with the inflation we have. And it's this loan to value math. 100 million office tower bought in 2018 now appraises for about 36 to 40 million. But the borrower still owes close to that 100 million. So the borrower is sitting with a $60 million loss. A $60 million equity has already been wiped out, and the shortfall must be recognized on someone's balance sheet. And then cascade channels, bank capital, regional banks hold 45% of the CRE loans. So it's going to be a big problem potentially in the regional banks, and we're going to continue to watch the banking. And then the mark-to-market losses erode your Tier 1 capital exactly the way we modeled in the micro velocity layer. So again, we're looking at velocity. And then the REIT and CMBS haircuts, failing NOI forces rating downgrades. So we're going to start seeing rating downgrades of the REITs, pushing those securities in restricted collateral list. And that'll reduce the VI of repo lenders that accept them. So there's going to be problems here in the repo market. And then we get into city and state budgets that could affect the Mooney market, where property tax receipts collapse, forcing austerity or defaults on municipal debt. So we're talking defaults in the Mooney bond market. And again, that will just further tighten liquidity. So it becomes a sort of spiral. So the bottom line is housing alone is a slow burn drag on velocity, but commercial real estate is a potential detonator. And the equity cushion in both sectors is thin, and the refinancing wall is imminent. When the collateral stops rolling, the same velocity equations that flagged SVB, remember that SVB Bank, Silicon Valley Bank, and the UK gilt crisis will flash red on the CRE markets first. So we're going to be watching. I'm modeling the CRE markets, and I'm also modeling the home construction. Now we're already seeing big slowdowns in housing starts. They're into the decline. They've rolled over and they're heading lower. And that's not good. And we're watching that as well. I don't think I have a housing starts model here. I may, we'll see. And then I'm looking at the pattern model here. You notice the stair step to the pattern model. We had the momentum actually back here in the pattern in 2013 to 2015. We then priced on the pattern. The market here is in blue. You see how it tracks perfectly. You notice here with a big corrective move in 2000, the big corrective move here in 2007. And then we priced right here perfectly into our velocity channel, dropping down now. Momentum's topped out. And then we burst out with the trend breaking. So this all has to now price back down here into the velocity channel, which puts us way down. I mean, you can see for a whole year, it's just hanging above. So you can see one stair step, two stair steps, and now there's a magical third stair step. I like patterns of three. Sideways, consolidation, breakout, sideways, consolidation, breakout. And I don't think we're going to see the breakout here. But what are you watching this in the pattern? But I really don't see the breakout with the V channel below. So if this starts to break down now and breaks this pattern down of stair stepping higher out of the 2012 low, that's going to spell a lot of trouble. Okay, so let's move on here. Now we're looking here at the pattern, and we can see in this pattern it's rising up. You notice we had a pattern breakout here in 2013. Now we're going all the way back to 1983 here, okay? And this is the pattern. And I don't want to get too much into this, but you can see that we're going to need to see a breakdown in this rising pattern out of 2012. And that can happen because look at the rising pattern here all the way down and then rising back up. So this is getting ready to the pattern to break lower again. So we're going to watch that. Now here's the recession model. We are very, very close on top of all these other issues of entering recession. So you can't see it here because it's kind of cut off here in this slide presentation when I enlarged it. But you can see we had a bull cross here of the signal right when the top started in 2000. Here's the bull cross of the signal at the 2007 top. Here's the bull cross of the signal at the 2020 top. And we are now getting ready to do a bull cross here in 2025. We are close to going in recession. So that begs the question, when is the Fed going to react? Or can they? We're going to see. But we are moments away from entering recession. A few months at the most, I would say. We're watching the global finance model because finance is going to be as much of a part of it. The strength is in fire, as I talked about in that previous report. Finance, insurance, real estate, and energy. And the energy model looks ugly. I'm seeing crude oil going much, much lower. So we're watching the global finance to see what happens on this velocity top. And we're going to be watching these velocity flows to watch them turn over. Here's the European finance. We're watching this top here. Here's the S&P Financial Industry Group. You can see we've got the mock line just trading sideways, and price now is crammed all the way up the top here. We've got the signal hitting the top. So we're watching those finance models, right? Now here is something that has me very worried. So let's stop right here real quick. This thing I call a parabola blowoff. Now I've talked to you about this parabola blowoff before. Now let's try to get to the end of this because we're running into some major 20 minutes here. We try to get this done. But you'll notice here, going all the way back here in time, here is the 2020 correction, right? I mean, this is the NDX, so it didn't look the same. It was bigger in 2020 with the internet blowoff, a smaller corrective move here. Here's the 2000 blip, 2020, doesn't even look like it corrected. 2022, and here we are 2025. But you can see this red line here, right? You notice here going sideways, trading perfectly to where it's supposed to trade in V. And you notice here when it moved down, the market corrected. Traded sideways, market traded sideways. Moved down, the market corrected. Traded sideways, but then the market was starting to rise. But notice the market was rising because this indicator's the V channel was rising. So the V channel starts to rise. Now notice it needed to rise because it had to get up back up here into the V. The V is between the topping momentum curve here of the dock. Again, we're modeling velocity, but not the same as the blue. This is a different sort of way of modeling the velocity of momentum. So you can see we've got a top right here now. Back here, right? Look, we're already over the top here. We've rolled over in the momentum top here on the curve. But what's mind-blowing here is you notice as we came up here to the 2022 top, look at, we entered into the V channel at mock. So we're priced right here. And you notice as we were chopping around here, we had that little corrective move. And now the thing's gone parabolic. And you notice you can even see here, look at the tiny little corrective move and that little corrective move we had here back in February and March. But this red now has to price back below this blue line. So if this goes from here to here, look how big of a correction that is. And the correction here caused this big of a sell-off. So this could force a sell-off fairly large back down here to the 3,400 area just for the red to get to the top of dock, and then it's going to potentially want to collapse. This parabola is ugly. It's gone vertical, and parabolas always ends in tears. Now, this has got to turn over first, so we're going to be watching that. But that's radical. I was looking at silver there. We got a triple top on silver, 1, 2, 3. Let's see if it can break out higher. But it's looking pretty good in the metals market. Again, in a debt deflation collapse, commodities and stocks head lower. So we want to be looking for tops in the commodity space, which would obviously be energy, crude oil, silver, and gold. Silver looks very good for a top. Okay? So that's it. I mean, that's just something I quickly put together there. I think that's really, really interesting. I really find that fascinating. Thanks for tuning in. I've got so much more I want to go over with you, but I wanted to take time on this video to talk to you about the idea of a debt deflation collapse. Now, I've heard some other analysts think that this may not happen until, sometime in the third quarter or further out. But I'm looking at my data model, and I think they're wrong on their timing. I think we're closer to that occurring than most think. I mean, I think we're very much in a window right here with, as I said, within the next 2 weeks, a month. We need the recession models ready to kick off. The Fed's going to have to react. Will they cut rates at the next meeting? I mean, it is really, really getting hot and interesting under the surface. Again, you want to get a hold of me, join the Discord membership, get a hold of me. I'll send you out information. And for the Discord members, I will model absolutely anything you want to take a look at. You just have to let me know. And that's something I do for my members. Hey, have yourself a great week. Thanks for tuning in. And we'll get back to a regular video here every week. Might have some daily updates, but not until it starts to get a bit more interesting. And at month end here, obviously July, we'll get a month end report this time out as well. Thanks for tuning in. I appreciate your time. Hit the like, hit the subscribe, and I'll see you next time. Thank you.